Hi, everybody. Lance Browning, Income Solutions, coming to you live from Troop Highway in Tyler. Hope you're well. Happy summer. Actually, getting closer to happy end of summer. Apologize for the lateness of this report. They require a lot of work to put together and then even more work to get approved for public distribution. So, appreciate your patience with us this year. That said, we'll go ahead and get started. So I've been getting calls for pretty much the last, year and a half. So, Lance, the market's up. The market's up. Actually, 7 stocks are up, driven by the latest rage of AI, or artificial intelligence. Apple, Amazon, Microsoft, Google, Tesla, Facebook, and Nvidia have almost completely pulled the entire market higher over the last 18 months or so. The way that the S&P 500 and the NASDAQ indices are calculated, a small handful of stocks can have a tremendous impact up or down. They can determine the overall direction of the quote-unquote market, even if the vast majority of stocks on that same index are moving in the opposite direction. This is exactly the case right now. Strip out these what we call magnificent 7 stocks, and the market's basically flat for the last year and a half. Another frequent call that I get is, Lance, so what are the experts saying? Let me just say this. There are 2 types of experts. There are those that don't know, and then those that don't know they don't know. Here were the stock market projections for 2024 from 20 of the best and brightest minds on Wall Street. Over here to the left, Fundstrat and Oppenheimer were both expecting a 9% gain in the market this year for 2024. JP Morgan, on the other hand, was expecting almost a 12% loss. That's quite a disparity. The other 17 analysts were everywhere in between. But I believe it also clearly illustrates how hard it can be to accurately predict what the market is going to do in the future. If you think they've got a tough job, how about trying to be this poor guy? So over the last 4 years, we've talked a lot about 4 separate economic indicators that we believe would give you a very good idea of where the economy is heading. We've called them the big 4 indicators. Our thought process here is that as the economy goes, so go the markets, at least theoretically. Here we see the Conference Board's leading economic indicator index. The black line is the actual index. The gray bars that run up and down vertically are recessions. Keep that in mind. You're going to see these gray bars running vertically throughout the rest of this presentation. One thing you'll also notice is that before each and every recession, there's almost always been a big kind of a camel hump in the index. As we sit here today, this index does not look good. You see in this box in the bottom right, the last 2 years have basically been straight down. So this begs the question, where then is the recession? Whether you're investing in a stock or a bond, you are, in essence, investing in the future cash flows, including earnings, of a company. So this is taken from LPL's earnings dashboard. You can see that the revenue has grown by 4.5% year over year in the companies in the S&P 500. Earnings per share profits have grown by 10.5% a year over year. This is for second quarter of 2024 that we just came out of. Common sense would dictate that if a company's earnings are growing, its stock price will grow as well. That's why corporate earnings are another one of our big 4 indicators. Following the economic collapse in 2008, and even more frequently post-COVID, the Federal Reserve has dramatically increased the amount of assets on its balance sheet. This was due to something known as quantitative easing, or QE. And I'll give you the Lancepedia definition of quantitative easing. The Treasury issues debt to flood the economy with cash. Then the Fed prints money to buy the government's own debt, pushing even more cash into the economy. The reason the Fed's balance sheet is one of our big four indicators is that there is a very strong historical correlation between the amount of money and assets on the Fed's balance sheet and the stock market. We'll talk more about the inflationary effects of QE here in just a second. But as you can see, the amount of assets on the Fed's balance sheet is decreasing. This normally would cause the market to go down. So far, that's not the case. The last of our big four indicators is the yield curve. So common sense would tell us that the longer you tie your money up, the greater rate of interest you will be paid. Under normal circumstance, that is exactly the case. Now, nothing post-COVID has been normal. Here you see the yield curve on the yield on the 3-month Treasury bill up here in the top left at 5.4%. Most short-term interest rates, like money markets and CDs, will be pegged to the 3-month T-bill, Treasury bill. All the way out to the right, you see the yield on the 30-year Treasury bond is at 4.6%. This is known as an inverted yield curve. In East Texas, we would probably call this bass-ackwards. Short-term fixed income is paying more than long-term fixed income. Inverted yield curves will often, very often, precede recessions. Interestingly enough, though, recessions don't actually occur or happen normally until the yield curve uninverts. Stay tuned on that one. So let's talk about which political party is best. And I get the calls, all the time. But so being the brave, intrepid guy that I am, I'm going to venture into a place where even angels fear to tread. I get it. We're all very passionate about things like religion, football, and politics. Over the last 27 years that I've been doing this, I've heard over and over that, if my folks get in, things will go up. If the other folks get in, everything's going down the tubes. These beliefs were formed in the womb. I get it. Our own biases aside, though, let's look at what the data says. Earlier this year, we put out a video blog we called The Politics of Investing. In it, we went back to the post-Civil War Reconstruction era and looked at historical performance of the markets by branch of government and party in power. Remember the old TV show Family Feud? And remember Richard Dawson? I think it's now Steve Harvey. But right before they give the answer, they always say survey says. So which political party is best for the market? Survey says market doesn't care. Average performance of the S&P is about 8.3% annually. You can see average performance by party in the White House, but dig a little deeper, you can see a breakdown by party in the House and Senate. The best performer overall, split Congress. Here you go, the far right, split Congress. In the movie Wall Street, Gordon Gekko, everybody remember Michael Douglas's iconic character. Gordon Gekko had a saying, he'd always say greed is good. When we look at the data here, I think we can say gridlock is good. So when we talk about investing our hard-earned money, I think it's important to prioritize the data over our own feelings. Every year in our halftime reports, we have a theme. Usually that theme represents one thing versus another thing. This year, our theme is going to be the consumer, specifically whether or not your consumer is healthy or unhealthy. The reason we care about the economy is that 2/3 of the U.S. economy is represented by the consumer. So here's a report from Bloomberg. They say, quote, as we mentioned here last week, U.S. consumers have worked through their excess savings this week. Soft retail reports reflected softening in spending. This is good news for inflation concerns. Markets have begun to price in weaker demand, and the consumer discretionary sector has fallen behind the broader S&P 500, specifically the 7 magnificent stocks. Year to date, the S&P has generated a total return of about 11.7%. Over the same period, consumer discretionary stocks have returned 2.4%. Now, credit card balances rose 13.1% in the first quarter, and the average credit card interest rate is 20.66%, and that's near an all-time high. The increased reliance on debt at high interest rates has driven an increase in delinquencies, which jumped 29% in the first quarter to 6.9%, which is above the 15-year average of 5.3. Continuing to talk about the consumer, let's look at excess savings. So in response to the COVID pandemic, the federal government and the Federal Reserve both flooded the economy with cash. We all remember the so-called stimulus checks. Here you see a huge spike post-COVID in excess savings. Consumers were sitting on a mountain of cash. So, what would any good red-blooded American do with excess funds? Well, you shop till you drop, right? Excess stimulus led to excess savings, which led to excess spending, which led to excess inflation. You can go back and listen to a couple of our previous halftime reports, particularly last year's, where we go into this in a lot greater detail. Problem: the punch bowl of this excess savings has now been taken away from the party. Consumer savings have absolutely collapsed, and you see that with the red line here, bottom right of this chart. This takes a lot of purchasing power away from that all-important consumer. No political pun intended here, okay? But let's talk about the gigantic elephant in the room. That elephant's name is debt. Household debt in this country is at the highest level it has ever been. And those figures are going to include mortgages, car loans, credit card loans, et cetera, et cetera. Now, this might seem a little scary, and it is, but while household debt is at record highs, debt relative to assets or net worth is nowhere near record highs. Every year, again, we have a theme to our halftime report. This year's theme is going to be the consumer versus the consumer. Why? Well, as we showed in the intro slide, there are two very different consumers living under very different economic realities right now. If you own assets, real estate, stocks, bonds, gold, oil, whatever, your net worth is very high because the markets have been high. You may still have a lot of debt, but you have the assets and probably the income to handle it. But let's talk a little bit more about that consumer towards the bottom rungs of the economic ladder. Here we see a breakdown of the record debts composition. The largest component is of course mortgage debt. Please keep in mind that real estate prices have skyrocketed and that mortgage rates are the highest that they've been in close to 20 years. The rest of this debt is what I like to call bad debt. And I don't know if there's such thing as good debt, but bad debt's going to be high interest stuff like credit cards, car loans, etc. And to be honest, this is a fairly big concern. And we talked about how important the consumer is to the U.S. economy. So what's going to be most important to the consumer? What would make them buy more stuff or stop buying stuff altogether? The word we're looking for here, survey says, is confidence. A confident consumer that feels good about their present and their future situation is a lot more likely to spend money. Here, the dark line represents the University of Michigan Consumer Sentiment Index. Again, gray bars going up and down show when recessions have taken place. Naturally, confidence drops a lot during recessions. Makes sense. Here's what I find very interesting. Consumer confidence very often tracks in line with the market. When the market's up, people usually feel better. There's actually a term for this. The Fed refers to this as the quote unquote wealth effect. The market's at all-time highs. To the best of all of our knowledge, at least we haven't been told, we're not in a recession. So what gives? Why are consumers feeling so down in the dumps? So I've been saying a while that the reason consumers are still spending and racking up tons of debt is that unemployment was extremely low. As long as people had enough steady income to make their minimum monthly debt payments, all was right with the world. So let's talk about that. Here's some commentary that we found very interesting. And this is there's getting to be a pretty big discrepancy between what the BLS, Bureau of Labor Statistics that's the government, is reporting and what the Household Employment Survey is reporting. I think this bears watching very closely. So I'll read this out to you. So the BLS jobs report show that the economy added 272,000 jobs, well above expectations of 175,000, and that 152,000 jobs were reported by ADP. ADP is private. BLS and Household Survey are not. Those are government. Also pointing to a strong labor market, average hourly earnings were 0.1% above expectations at plus 0.4%, so almost 0.5%. While the jobs data seems strong on the surface, there's a lot of other data within this report, leading us to question its veracity. For starters, the unemployment rate rose from 3.9 to 4%. While the economy did add jobs per the establishment survey, the unemployment rate calculation uses the household survey. BLS survey is going to be for large businesses. Household survey, still a government survey, is going to represent smaller businesses like mine, for example. So this shows the number of employed people fell by 408,000 jobs. Further, the labor force participation rate dropped from 62.7 to 62.5%. That's what percentage of able working of the population is actually in the workforce. The graph below shows that over the last 6 months, the headline garnering establishment survey, big companies, has added 2.3 million more jobs than the household survey. This dwarfs any divergent we've seen since the COVID pandemic. One of the challenges you have when you have high inflation is growing your income enough to compensate for those rising prices. The problem this go around is that wages haven't been doing that. Consumers, and again, especially those towards the bottom of the economic ladder, have been faced with some pretty tough choices. So they can either A, cut back on their spending, and this is assuming that it's not stuff you got to have required spending, or B, borrow money so that they can keep spending. And I think what we saw from our previous slides on household debt answers this question pretty clearly. We focus so much on employment because that allows the consumer to spend money. If they have jobs, they can buy stuff, or at least make the minimum payments on their debt. Over the last couple of years, unemployment has been incredibly low, historically low. Unfortunately, that appears to be changing. Here we see the average employment index for manufacturing and service-related jobs. The majority of jobs now are service-related. The unfortunate thing about that is those service jobs tend to pay a lot less than high-tech, science, technology, engineering, math, manufacturing jobs. And you can see employment here combined has dropped in this blue line considerably. Even in a strong, quote-unquote, strong unemployment rate, you kind of need to pop the hood and look beyond the headline numbers. Here, the dark line is all employment. That's going to be full-time and part-time. The gray bars going up and down again are recessions. You can clearly see that employment gets very high. See the camel humps again, and unemployment gets very low when the economy is expanding. One of the trademarks of recessions is higher unemployment. Notice that this employment line is dropping even though we haven't, at least officially, had a recession. Interesting. Another interesting thing about the employment numbers, and this is from our friends at First Trust. First Trust, my opinion, are the best in the business. So First Trust says the civilian, not government, employment report shows full-time jobs down 1.6 million in the last year. So full-time jobs down 1.6 million. Part-time employment is up 1.8 million. So you're seeing higher wage jobs replaced with lower paying service sector jobs. You're seeing full-time jobs replaced with part-time jobs. Many of those that are working, many of those people with the part-time are working multiple part-time jobs. Had a guy the other day delivering something to the house, and I was talking to him, and he told me he delivers groceries and stuff for Walmart on his day off, and he makes about $400 to $500 a week delivering on the side as his side hustle. So I think all this really bears watching. So this chart very much bears out what the good folks at First Trust were saying. Here you see a very steep drop here to the far right in black in full-time employment. And this is big since the post-COVID recovery. As we continue to beat the poor dead employment horse, take a look at this. FHA, which is Federal Housing Administration, housing delinquencies are up very sharply. Why? Probably unemployment. We've been saying that consumers have been able to keep up their spending because they made enough to make their minimum monthly debt payments. Here you can see pretty clearly what rising unemployment could do to that scenario. We believe that the future direction of the markets and the economy will very much be driven by the Fed in the near term. So, disclosure disclaimer, and many of you know this, I've been very critical of the Fed over the years. I refer to the Federal Reserve Board of Governors as the Sanhedrin. I call Federal Reserve Chairman Jerome Powell Darth Powell. Here he is at the bottom in a Riddler costume. So just once, I would like to see Jay Powell come out for a press conference wearing the Riddler costume from Batman rather than a suit. I think it would be really, really appropriate. So let's lighten the mood here a little bit and talk about what the bulls want. Here's what could go right. Bulls are optimists. They're eternal optimists. They think the economy's going to do better. They think the market's going to go up. They're pretty happy-go-lucky. So the bulls believe that what the bulls would like to see, what could go right. We could have a so-called soft landing or no landing scenario where the economy continues to grow without big inflation and while avoiding a recession. The bulls would like to see the consumer remain employed and resilient and able to make those monthly payments. Bulls would like to see some euphoria over the results of the November elections. Lastly, and this is a thing, this is real, we're going to show you in a second, there's a mountain of cash on the sidelines. The bulls would like to see that get redeployed productively into something other than short-term fixed income. If you're bullish on the economy and the markets, this slide should make your face light up like Christmas morning. So from 2009 to 2022, investors and savers earned exactly zero on short-term bonds, CDs, and money market funds. Savers were punished. Starting in early 2022, here comes Darth Powell and the Sanhedrin Fed. Rates went from near zero to 5.5% seemingly overnight. Suddenly, people actually felt rewarded for hoarding cash, and hoard they have. So here you see in the blue, there's approximately $23 trillion with a T in cash and short-term cash equivalents, like treasuries and CDs. There's another almost $6 trillion down here in the green in money market funds. That's almost $30 trillion worth of dry powder that could be invested in the economy, in employment, and more specifically, in the markets. The bulls believe that once interest rates do start to come down, people will flee these short-term cash instruments and actually put that money to work, specifically in the markets. They may very well turn out to be right. So if you're a bear, you're a pessimist. The glass is half full. In fact, there's probably not even a glass. And so here's what the bears think. Here's what could go wrong with what we've talked about today. So get the optimism out of the way. So a lot of things we talked about earlier could come to fruition. An over-indebted consumer could finally tap out and slow their spending. With consumers spending less, publicly traded corporations or any company could see their earnings drop due to slower sales of their products and services. These reduced earnings could cause these companies to cut costs, i.e., start laying off workers. The greatest expenditure most companies have, somewhat controllable, is labor. So these reduced earnings could cause layoffs. Unemployment would then rise. An unemployed consumer then spends even less, causing this cycle to spin faster and faster. In years past, we would always reference something called a black swan event, something random that just happens out of the blue, but it still affects the economy and the markets. It seemed like every time I mentioned the possibility of a random black swan event, something would happen. COVID, the Ukrainian invasion, whatever. So that I don't catch any more grief from all of you and I don't get blamed for anything else, I am not going to mention black swans in this year's report. Not going to happen. The greatest risk we see at this point is stagflation. If you'll remember, during the 1980 presidential campaign, Ronald Reagan referred to this as the quote-unquote misery index. If you'll give the definition, and I'll give you the definition of stagflation from Lancepedia. So you've heard of Wikipedia, Investopedia. This is Lancepedia. So stagflation is a period of slowing economic growth coupled with higher inflation. Inflation is higher than economic growth at that point. When this occurs along with rising unemployment, you get what is known as stagflation. So let's leave you with a bit of optimism here. We want you to leave with a smile on your face. So here we go all the way back to 1980. So we've got about 44 years of data. We show year by year the annual return of the market, the S&P, that's in black up there, those black bars. We also show here in the red dots, the biggest drop in the market during that particular year. You can see here the crash of 1987. That was Monday, October 19th, 1987. The market dropped 34%. Most of that was one day in October. Here's what's interesting though. Even after that crash in October, late 1987, the market actually finished up that year by 2%. Moving to the right, we see the plunge in the spring of 2020 from COVID. At one point late in March, and again, this happened over 6 weeks, y'all. At one point in late March, the market was down 34% year to date. However, the market didn't stay down. It was actually up about 16% for the full year. Quite a recovery. Across the top here, you're going to see where it says the average intra-year drop in the S&P is about 14.2%. We've been telling folks for a while that the market can drop 5 to 15% at any time just because. This data certainly bears that out. Here's the cool part though. Even with these average declines, the market still managed to finish up 33 out of those 44 years from 1980 to 2024. That works out to about 75% of the time. So pretty good odds, pretty good win percentage that the market's going to be up in any given year. We'll close here with a word from our attorneys, but last I want to tell you, we did publish a book. I put out my first book last summer, and if you'd like a copy, let us know. Happy to sign that for you and send that your merry way. Happy to give you those. We don't sell those. We give those away, so let us know and I'll send you one. We'll close with a word from our attorneys. Here you go. As always, please feel free to reach out. We are here to help. God bless. Have a great rest of the year, and we'll talk to you soon. Thank you.